In this video, we're going to do an example of how to use absorption costing to calculate a company's operating profit or loss. So we've got some cost data right here and also sales data. We've got selling price per unit. We've got direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, and fixed SG&A. And then we've got some production and sales data down here for 3 years. And we'll calculate the operating profit or loss for each of those years. We're going to need to know the beginning balance of inventory and ending balance of inventory because this fixed manufacturing overhead in some cases can be deferred to future periods. We'll get into that. So the first thing is when we calculate the selling price and direct materials used, direct labor, all those things, we just multiply them by the amount of sales for the period, which if you notice, there's the exact same amount of units sold each period. I tried to make this a simple example. So there's 10,000 units sold each period. So for example, revenue for each period will be $550,000. And that's just $55 times 10,000 units sold. And so we see sales revenue, $550,000 every period. So let me just put in the years here. So there's 2020, 2021. Then if you look at direct materials, it's $4 a unit, 10,000 units sold in each period. So each period that is going to be $40,000. Really, the only thing that doesn't follow this pattern is fixed manufacturing overhead. And that's the trick with absorption costing, is how to deal with fixed manufacturing overhead. So this is what we're going to be trying to calculate here. Everything else is pretty simple. Fixed SG&A, $60,000 every period. Okay, it's $60,000 every period. Variable manufacturing overhead was $25 per unit. We sell 10,000, so that's 250,000 in each period. So let's focus on the fixed manufacturing overhead and ignore those other kind of trivial details. In 2019, we figure out our fixed manufacturing overhead per unit. So we said, well, there's 150,000 for the entire period of fixed manufacturing overhead. Divide that by 10,000 that we produced. That is $15 of fixed manufacturing overhead per unit. But we sell 15 or all 10,000, so actually 10,000 times 15 is $150,000. So that's $150,000. Okay. So it's really actually the first period is exactly the same as it would be if we were using variable costing. So anytime the amount you produce and the amount you sell are exactly the same, and so you're going to get the same outcome as variable costing. In year 2, in 2020, we've got a difference because we actually produce 15,000, but we only sell 10,000. So here's how that becomes a little tricky. So here's the 150,000 fixed manufacturing overhead. Divide it by the 15,000 we produce to get the per unit fixed manufacturing overhead. It's $10. $10. Okay, that's just 150,000 divided by the 15,000 we produced. We're spreading the manufacturing overhead, the fixed manufacturing overhead, across all the units we produced. But then we only sell 10,000. So 10,000 times $10 is $100,000. So you might be thinking, hey, what happened here? We had 150,000 in fixed manufacturing overhead for 2020, yet we're only recognizing 100,000. That's because 50,000 of that 150 that was in 2020 is going to be deferred until 2021. It's being pushed into the future. It's being attached to inventory because we have ending inventory of 5,000. If you want another way to figure it out, instead of figuring out the per unit fixed manufacturing overhead and multiplying by the sales, you could just think about it kind of logically and say, look, we produced 15,000 units. We only sold 10,000. That means there's 5,000 in ending inventory. 5,000 divided by the 15,000 we produced is 1/3. Okay, so basically 1/3 of what we produced is going. So 1/3 of the 150,000, which happens to be 50,000, is going to be deferred till 2021. Okay, so we're basically saying, look, we're going to expense 2/3, 10 divided by 15 of the 150,000, but then 5 divided by 15 is going to be deferred to the 2021. Now. So now we've got our fixed manufacturing overhead is different for each of those periods. Okay, now in 2021, we have the opposite of happening of 2020, where we actually sell more than we produce. Because in this period, we start with 5,000 units already in beginning inventory. Remember, we had deferred some of that 50,000 of the fixed manufacturing overhead, but we only need to produce now 5,000. So we produce 5,000. We started with 5, we produce 5, so that gives us 10, and we sell all 10. So there's no ending inventory. What does that mean? That means that we're not going to defer any of our fixed manufacturing overhead going forward. It's all 150 is going to be recognized here in 2021 because there is no ending inventory. There's nothing to be deferred. But remember, we also had 50 of the 150 for 2020 that got deferred to 2021. So 2021 is actually going to be the 50,000 from 2020 that was deferred plus 150,000 of 2021. Okay, so this is actually going to be $200,000. So notice the only thing that is different with absorption costing, the only thing that's a real trick is how to deal with the fixed manufacturing overhead. It's different each period. Now, what does that mean in terms of our operating profit or loss? Well, in the first period, the first year, 2019, we actually have a loss of 10,000, which is the same we would have had if we were using variable costing. But then in 2020, we have a profit of 40,000. Why do we have a profit? It seems weird because actually we sold the exact same amount of units in every single period. Why would we sell the same amount of units and yet have a profit here and a loss here? And the reason is that it's just because we produced more than we sold. So some of that fixed manufacturing overhead got deferred until the next period. Okay. So, and then in 2021, when that deferred stuff from 2020 catches up, we actually have a lot more fixed manufacturing overhead because it's not just 2021, it was from the prior year too. So then we have a $60,000 loss. This doesn't seem to make sense. And this is why a lot of people like variable costing, because if you did variable costing, it would just be 150,000 of fixed manufacturing overhead expensed every single period. So this wouldn't be 100, it'd be 150. This wouldn't be 200, it'd be 150. So if you did variable costing, you would have a loss every period of 10,000. And they all add up to the same. If you add up either way, so this is absorption costing here, and that if you add these up, you end up with $30,000 of losses. And then if you add up these here under variable costing, you get $30,000 of losses. So it's really a question of timing. That's the difference between absorption costing and variable costing. And with absorption costing, a manager, just by basically making the decision to produce more units than they sell in any given period, can defer some of the fixed manufacturing overhead to a future period and then make the current period appear to be more profitable.